What's good, all my trader and investor homies? It's your boy Kevin. This is Touchdown Trades, the home of the #1 stock market trading and investing channel on all of the tube. In today's video, we're going to be talking about the hottest stocks in the market right now. They are on fire. They're headed to the moon. But one big problem, and that's two of these penny stocks that we're going to be talking about. Two of the most popular stocks in the market right now, I think, are overhyped, and they are too expensive at the levels they're at right now. And this is going to rub a lot of people the wrong way, but you know what? I just don't give up. Two of the penny stocks, big warning, red alert, code red. One of the penny stocks we're going to be talking about, I think, is an all green lights buy. I think the sector's about to take off. The sector is extremely hot, and I think this one stock has 200-300% upside potential, and I'm not over exaggerating when I say that. If you're new to the channel, do me a big solid and go down there and hit that subscribe button for me and turn on those notifications. And if you like free money, free dinero, everybody likes free money, check out the link in the description for Webull, where I use every single day. They're offering you guys 2 free stocks valued up to $1,800 if you sign up with the link in the description. All right, let's break down these penny stocks that have been on fire. Let's get it. There's typically 2 or 3 penny stocks making a 100% plus gap up, and that is not typical. That is not normal. Typically, we see maybe one stock making a big move every day, but over the last couple of weeks, it's been 2 or 3 every single day going to the moon, baby. And I think that's partly due to the fact of the GameStop, the AMC effect. We have a ton of new traders coming into the market chasing the hype. And that can be good. There's new money out there. We can exploit that new money and profit from it. But it's also bad because those people who are chasing these small cap penny stocks and buying at the top, they have the potential to get hurt. So in this video, I'm going to put a warning on 2 small cap stocks that I think are kind of hyped up right now. And I'm going to put an all green lights buy on another penny stock that I think is about to explode. I think the whole sector is exploding as we speak. The stock that I like, the first stock that I want to talk about that I think is a buy at these levels is this SNDL, sundial growers, and MJ, a Mary stock. The whole Mary sector has taken off as Chuck Schumer and the Democrat majority has said that they're pushing for legalization in the next couple of years, and I expect that to happen. And I even expect southern states, typically conservative states like the state where I live, Georgia, to switch over and realize the potential tax revenues that legalization can bring to their states. SNDL, Canadian-based company, MJ Company, I think is one of the best value plays in this entire sector. They offer products on every end of the spectrum. You have the grasslands, which is their value pricing. It's that Reggie, baby, that Bobby Brown, all the way up to their connoisseur brand, which is their premium product offering. If we take a look at some of their product offerings, we have Top Leaf, which looks like a pretty high quality, high-class product offering, a more expensive option. And then we go down the list and you can see that you get into the more common consumer product offerings. And this is going to be just like a wine, right? You can buy a cheap glass of wine or you can buy that high-quality stuff. I think the real money is going to be in these pre-packaged vape pen products because your average guy, your average business guy who's working a 9 to 5, he gets off work, wants to relax with his wife, have a good time, watch some Netflix, goes to the store. He doesn't want to buy the buds, have to take it home and roll it up in a swisher himself when he can just buy these vape pens pre-packaged, buy a couple, go home with his wife, have a good time and relax. I think the real money is going to be targeting the mass consumer with these vape pens, and SNDL has this product to offer. So right now, SNDL has a pretty small market share of Canada, which offers them a lot of room to grow. Okay, so overall, they have a 3% share of Canada, around 3% share. So there's plenty of upside for this company to expand and grow, let alone expanding into the United States and other countries. We can see here that this chart is comparing SNDL to its Canadian peers, companies like Canopy Growth, Aurora, Tilray, Hexo, and Sundial in most metrics is trading at a discount compared to its peers, which is making SNDL a value buy at these price points. If we take a look at the chart here, we can see that SNDL did have a huge run up. A run up from less than $1 per share down here, boom, to the moon, all the way up to almost $5 per share at the highs. But today with Tilray falling by almost 50% off the highs of yesterday where it closed at, more than 50% from the pre-market highs of $76 a share. Tilray just crashed today. We saw SNDL with follow the leader, kind of a sympathy sell-off, and I think it's giving the opportunity to buy this at a level I did not expect to see again for a while. So we do have some support down here under $2 a share. And if we get anywhere near that area, that $2 area, I think this is a good value buy, as the entire sector sees continued strength, in my opinion, through over the next couple of years. Price target wise, I will put a 2-year, 24-month price target on SNDL of $7 per share. That is more than 200% upside potential. Now we're going to need to see the bigger Canadian Mary Jane companies start to take off again, like Tilray, CGC, Aurora. Those type of companies are going to need to regain their strength in order for SNDL to make that type of move. But I think that happens. All right, let's break down the first stock that I want to slap a warning tag on. I'm skeptical of these two stocks trading at these levels. I think they're too hyped up, and there could be some major pullbacks coming in the near future. Now, I know some of you guys aren't going to like me talking bad about these two companies, and that's okay. I can take the hate. Roast me in the comments. If you don't want to hear what I have to say, that's fine as well. I do have a long track record of nailing these small cap stocks before the moves happen. Zomedica, ticker ZOM. I did a video of it back here when it was trading under $1 per share, talking about how I like the company. And I do like the company and what they have to offer. But after this type of move, we've seen a move over the last few months from 20, 30 cents a share all the way up to almost $3 per share, 1,000% plus move. I think the hype is a little bit too much right now. I think the FOMO is real. It's trading massive volume every single day. Let's talk about why I think there could be a pretty significant pullback in the coming weeks. All right, so Zomedica is coming out with this truforma machine. They're going to be releasing it on March 31st. And the concept for this truforma machine is a diagnostic machine for veterinary medicine where they can test for adrenal and thyroid issues in dogs and cats. Awesome, awesome concept. Don't get me wrong. The concept is awesome, and I think it can be a successful product. But I think this is what a buy the rumor effect, a pre-anticipatory run-up. We're seeing a ton of traders and investors buying into the hype, buying into the FOMO, and it's made a massive move, and there's nothing wrong with that. There's nothing wrong with taking a trade on a stock because you have a thesis that the stock's going to run up into some important news, a buy the rumor effect. But even though I like the product, we're talking about a company that has zero sales, zero track record. Let's say they get this product to market and it works out. Great, but that's already priced into the stock. A good showing of this truforma product is already priced in the stock. We have no sales, a market cap of approaching $2 billion, and I just think we're a little bit extended at this level. I expect a pullback if the numbers come back for the truforma showing. The first initial results that come back after the product launch are even a little bit short of great, then we see a huge pullback in truforma. I could see this thing pulling back down from the 278 level where it's at now, back down towards $2 per share, maybe even lower if those results are not perfect. The second stock I want to slap a warning tag on, big red, code red alert here on SENS. Sensonics Holdings, ticker SENS, has been another penny stock that's made a giant move from under 50 cents a share up to $4. That is a massive move, almost 1,000% run up there on SENS. We have seen the huge spike And I think it's getting a little bit ahead of itself, and I expect a pullback in the coming weeks. Sensonics is another company coming out with an innovative product. They are trying to solve the problem for diabetic patients who are sick and tired of pricking themselves 100 times a day to check their glucose levels, and they came out with this awesome product. You put a sensor in the patient, the sensor then transmits the glucose levels to a transmitter, which then transmits it to a mobile app, so the patient does not need to prick themselves a bunch of times a day. Sounds good on paper, sounds like an awesome product, and I agree. We talked about SENS way back here on the channel. When it was trading under $1 per share, I said that I was looking to invest in this stock. It then ran up huge. So what has been my change of heart with this Sensonic Holdings? Number one, they don't have FDA approval right now. All the research that I've done has shown me that they're only working to get approval currently in Europe. And that brings me to a Super Bowl commercial. Damn Jonas Twins. Damn Jonas Twins ruined the party again. They are always ruining the party. And this Dexcom has a product that is almost identical to the Sensonics product. So we go to Dexcom G6, and it is a sensor where the diabetic patient can check their glucose levels, transmits it to a mobile app. They wear the sensor on their body, transmits it to an app. They don't need to prick themselves a bunch of times a day. What's the difference between Dexcom and Sensonics? Well, there's one big difference, and that is FDA approval. Dexcom's product is already on the market. When you buy SENS, you're basically buying a lottery ticket, banking on the fact that their product can get FDA approval, and it works, and doctors pick it up, and they start giving it to their patients. With this Sensonics, you're looking at investing in a stock, a biotech stock that has a market cap north of $1 billion on basically no sales. No market share whatsoever right now. So it's basically a lottery ticket. But with Dexcom, you're talking about a company with a very similar product, a market cap of $38 billion, but sales of $1 billion, almost $2 billion, and a profit of $231 million. So Dexcom's profit is about 1/5 of Sensonics' market cap. Sensonics market cap of $1 billion, Dexcom market cap of $38 billion. But the big difference here is Dexcom has a product already out there, people already using it, and they're already a profitable company based on those products. So with Sensonics, you're basically buying a lottery ticket. With a company like Dexcom, you're getting a product already out there in a company that's already profitable. So I don't think there's anything wrong with Sensonics buying it way back here at 80 cents, even $1. That was you had a thesis that this was maybe going to get FDA approval. The risk-reward ratio matched up, but I think the risk-reward right now is not in your favor. If you're buying up here at $4 per share almost, there's much more that can go wrong than can go right. Sure, if the company comes out with FDA approval, this stock will sky. If they can get this product to market, this stock will sky. I just don't think the risk-reward is matching up, trading after making that almost 1,000% move in just a couple of months. So that's going to wrap up the video, guys. Just a couple warnings on these FOMO hype stocks. They offer good products, but after a stock makes a move like that, I think you need to give it time, let it cool off, ingest the news, do some research, do some due diligence. Make sure you're not giving into the FOMO and the hype. I think the MJ sector is about to take off. I think SNDL is a really good stock, a really good long-term play to get some exposure to the MJ sector. Zoom, I like the truforma. I think it has potential, but I think the risk reward is just not there right now after the big move. Same with Sensonics. I like the product. Maybe it has potential. Maybe it sees FDA approval at some point, but I just don't think the risk reward is matching up. That's going to wrap it up, guys. I love all of you. Catch you guys in the next one. Check out the link for Webull. Check out the link for the free trial to come trade with me in the private Discord chat. Peace.